Hello. Good morning, everybody. Hello and welcome to the Sheraton Athlone Hotel. My name is Joe Cleary and I'm the Managing Partner of RBK. I'd like to welcome you all on behalf of RBK and AIB to the 2026 budget briefing held in conjunction with Athlone Chamber of Commerce, both to all of you both here in the Sheraton Hotel Athlone and those joining us today online. Budget 26, amounting to 9.4 billion, was presented as a sensible budget aimed at maintaining economic stability and strengthening Ireland's resilience and amidst global uncertainty. The government outlined plans to move away from temporary budget supports towards targeted and permanent measures while maintaining a focus on balancing the public finances. Framed as both cautious and forward-looking, the budget sets out to address ongoing pressures in housing, investment and the cost of living, while supporting employment and economic competitiveness. In his address to the Dáil, the Minister for Finance, Paschal Donohoe, said, "This budget will protect jobs. It puts us in the best possible position to create a stronger and more competitive economy while meeting the needs of our people today and in the time to come." So, to follow on from this, we have two fantastic speakers lined up for you today to talk you through all that detail. Firstly, we'll hear from my colleague Mike Scanlan. Mike is a tax director with us in RBK, and he'll provide an overview of the tax measures that were outlined yesterday. Following Mike is David McNamara, Chief Economist with AIB, and he'll give his expert opinion on the likely impact of Budget 2026 on the greater economy. Finally, Tommy Hogan, CEO of Athlone Chamber, will say a few words on behalf of the Chamber and chair the panel discussion that will ensue. So, look, I won't keep you any longer. I'll just call on Shirley Donohoe from AIB to just maybe say a few words of welcome on behalf of AIB. Thank you.
Thank you very much, Joe. Good morning, everybody. For anybody that doesn't know me, my name is Shirley Donohoe. I head up the Midlands North East Business Banking team for AIB. So on behalf of AIB this morning, I'd firstly like to welcome you to the event and to thank you for your attendance. We're delighted again to partner up with our colleagues in RBK and our colleagues in the Chamber, Athlone, to host this event for you this morning. Joining me this morning are my senior relationship management team from business banking here in Athlone. We have our local branch manager, Veronica Murray, and we have colleagues here from Business Banking Branch Network and also representation from our finance and leasing teams. So I hope you get to meet some of our colleagues here this morning. We're absolutely delighted also to welcome this year our Chief Economist in AIB, David McNamara. So David's going to give you a presentation on the Budget 2026, see what the impacts are and how it's going to impact the economy and I suppose ourselves. So thank you, David, for travelling. I suppose before finishing up, I just want to put a special thank you out there to Deirdre McElroy from RBK. Deirdre puts an awful lot of work herself and her team into organising this event, and we do appreciate it, Deirdre. Thank you very much. So I hope you have a lovely morning and that you enjoy it. And without further ado, I'm now going to hand you over to Mike Scanlan, Tax Director there for RBK. Thank you. Thank you.
Good morning, ladies and gents. Thank you to Joe and Shirley for the introductions. My name is Mike Scanlan. I'm Tax Director with RBK. And for the next 25 minutes or so, I'm going to take you through some of the tax changes announced in Budget 26. I suppose listening to some of the commentary over the last 24 hours on the budget, I suppose the main word that has come across is tinkering when it comes to the tax side of things, but the Minister put it much more eloquently when he said, "A plan to strengthen the resilience we have shown in the past, underpinned by a sensible budget that will safeguard our future." 9.4 billion budget package, 1.3 billion to tax with 8.1 billion of an expenditure package. What's missing up in the top right hand corner from last year there is the cost of living measures, which would have been 2.2 billion this time last year. Obviously we've moved away from that and it has been stripped out. Here are some of the headings we're just going to look at the budget under over the next 20 minutes or so. And I suppose no surprise, given where we are, that property and housing was probably the foundation of the budget speech from the tax perspective. Headline item, housing and VAT, a reduction from 13.5% to 9% for the sale of completed apartments. So that kicks in from today out to the 31st of December 2030. I suppose initially some of the questions that cropped up when we were preparing these slides in advance of any further detail on it was, what's the definition of an apartment? Will there be a limit on price or floor areas? And what's really to compel a vendor to pass on the 4% rate? In terms of a definition of an apartment, that has been clarified since it's tying in with a definition that's there from the stamp duty rules. It's based on a number of floors and a number of apartments. So at least that much is clear. In terms of passing on the 4% rate reduction, I suppose there was even mixed messages coming out there yesterday in the speech. It was very much about increasing supply, which would make you think it's more for the construction industry. But afterwards in the reaction, there was very much, no, this is to make apartments more affordable. So with an expectation that it would be passed on, but we'll have to wait and see how that all washes out. There's going to be a new enhanced corporate tax deduction, again related to apartment construction costs. How does it work? An enhanced 125% deduction for actual qualifying construction costs incurred, subject to a maximum deduction of 50,000, so maximum tax saving of 6,250 euros. In essence, you spend 200,000 in qualifying costs, you'll get a deduction of 250,000, so an extra 6,250 saved in tax. A few other terms and conditions, as always. It's available for projects comprising of 10 or more apartments. It is for both new build and conversion, so there is this big push where there is commercial property, maybe industrial estates that aren't being used, to convert them into residential apartments. Again, it's available where a commencement notice is submitted from today and before December 2030, and the deduction will be claimable upon completion. So when there's a certificate of completion in your hand and the apartments are finished, you'll get the additional deduction. The residential zoned land tax, this was first introduced in Budget 2022, but only came into effect earlier this year in February 25. What's it all about? It's to make sure that land that is zoned for residential is being utilised and is being used to combat the housing crisis. Rate at 3% in the market value of the land. What was the tweak that was announced yesterday? There's a further exemption opportunity in 2026 if you want to have your land rezoned to take you out of this residential zoned land tax. So the most practical example of that would be there are areas which are on the maps for this residential zoned land tax, which are part of farms that are being actively and commercially used. So the farmers can go and apply for an exemption to say, look, I want to be taken out of the RZLT because I'm using it for farming. Any exemption application will be considered by the local authorities. There's a new corporate tax exemption that's been announced for cost rental housing. So you may have heard of the cost rental scheme. It's a scheme that offers affordable long-term rented accommodation for those that may have income that would be over the limits for full social welfare rented accommodation. It's 25% usually off market value is how it works out. What this new exemption states is that rental profits from homes within the cost rental scheme will be exempt from corporate tax. It applies to developments designated as falling within the scheme from today's date. But one word of warning on that, properties designated as cost rental accommodation are subject to very strict criteria, so it's not everything that's going to fit into this. The Living City Initiative, very apt for where we're sitting today in the lovely town of Athlone. What's it all about? The Living City Initiative has been with us for a while now, and it supports the enhancement of older housing commercial stock in regeneration areas in the cities currently. So it's about getting people back in to live and work in the city centres. There's three types of relief: owner-occupier, rented residential, or commercial or retail relief. And how do those reliefs operate? For the owner-occupier relief, an individual incurs qualifying expenditure, has to be at least 5,000 euros, is entitled to tax relief by way of a deduction from their total income. The other two reliefs are granted by way of what are known as accelerated capital allowances over a 7-year period. The changes that were announced yesterday, it was due to expire It's been kicked on to the 31st of December 2030. Up to now, the only properties that would qualify had to have been built before 1915. That magic date now has moved to 1975, so bringing a whole new stock of buildings into the net for this relief. And it also is going to be the introduction of a new category of tax relief for the conversion of commercial to residential, including over-the-shop premises. And if you fall into this category, there's no building age. Okay, so it can be any property once you fall into those criteria. The maximum amount of relief increased to 300,000 from 200,000, where works are carried out by enterprises. And it's hoped that with some other tweaks and changes in the finance bill, this will give greater flexibility in claiming the relief. The other big change was that it's not just going to be the cities now, but the 5 regional hubs as part of the National Development Plan have been added to the Living City Initiative. So Athlone, Drogheda, Dundalk, Letterkenny and Sligo. So what's the next step for these towns? Basically, the local authorities will be put to work to identify special regeneration areas, and once that's done, then we'll be able to move forward in claiming those reliefs. Another new tax that's come in as part of the budget yesterday, the derelict property tax. Now, there is already a derelict sites levy. It came in as part of the Derelict Site Act in 1990. It's an annual 7% levy that the local authorities can apply to derelict sites in urban areas. It's going to be replaced in the future, not immediately, in the future, by the derelict property tax. It will be collected by the revenue commissioners. Next steps on this, local authorities will start to identify the derelict properties in 2026. A preliminary register should be available sometime in 2027, and at that stage then the new tax will come into effect once the register has been published. No indication yet of a rate of tax, but it's not expected to be lower than the current 7%, so it'll be 7% or higher. The Residential Development Stamp Duty Refund Scheme. So this scheme provides for a partial repayment of stamp duty paid on the acquisition of land where the land is subsequently developed for residential purposes. So 7.5% rate of stamp duty when you're buying commercial or undeveloped land. And then if it's put to a use of developing residential properties, you can get some of your stamp duty back. This was due to expire for new commencements after 31st December 25. It's been extended on to the 31st December 2030. There were time limits from acquisition to commencement, and from commencement to completion, it was 30 months, now it's 36 months. And the other major gripe with this scheme was the timing of getting the refund, and one tweak they've made on that is now there'll be a full refund in respect of a multi-phase development at commencement of first phase. So you'll see these developments where you've got first phase, second phase, third phase developing out a large site. Once first phase has kicked off, the full refund will be available. There is an existing tax relief. It's a maximum of a €10,000 deduction for retrofitting by landlords. They can get that deduction against rental income for certain retrofitting expenses incurred on rented residential properties, but they must have an approved SEI retrofitting grant. And just another thing to note on that is your tax deduction is net of the grant. So if you have €20,000 of expenses but you get 13 grand of a grant, you just get a €7 deduction, €7,000 deduction. The scheme has been extended for a further 3 years to the 31st of December 2028, and the number of properties for which landlords can claim the relief has been increased from 2 to 3. In terms of household supports, I suppose, again, this was one of the big ticket items that has come out over the last 24 hours. No changes to tax rates, tax bands. Small tweak to the USC. The second band, the 2% band, has gone up by €1,318. That's to take account of the increase in the minimum wage. The rent tax credit has been extended for a further 3 years to the end of 2028. That's a credit for rent paid on property used as a main residence to facilitate attendance at work or for your child if they're attending college. The credit is €1,000 for a single person, €2,000 for jointly assessed, and there's other conditions as well that need to be fulfilled. The mortgage interest tax relief has also been extended for another couple of years. This basically is to give compensation for people whose mortgage interest costs have increased since 2022. You must have had an outstanding mortgage balance of between 80,000 and 250,000 at the 31st of December 2022 to qualify. And the credit has been extended, like I said, for 2 years, but on a tapered basis. It's currently €1,250 for 2024. It'll be the same for 2025 now. And 2026, it's going to drop to 625, at which point it is likely to expire. There's just a summary of the USC rates and bands with that slight tweak to the 2% band. No change to the 3% surcharge for self-employed income, so any self-employed people earning over €100,000 get hit with that 3% surcharge. They also extended out the relief for medical card holders for a further 2 years, which caps them at the 2% rate of USC. Something that wasn't mentioned in the budget but is good to mention is PRSI rates increased last week, 1st of October, by 0.1%, and there are further increases flagged out for the next few years. So October 26 will see a 0.15% increase, same in 27, and a 0.2% increase in 2028. Some income tax exemptions that got renewed. Anyone involved in the manufacture or repair of uilleann pipes, some good news for you this morning. The first €20,000 of your profits can be disregarded for income tax. This exemption was due to expire in 2025 but has been extended by 3 years to the 31st of December 2028. I will hold my hands up when that was announced yesterday. I didn't realise there was a relief for uilleann pipe makers, so my apologies to you all. In terms of those of you who have solar panels on your roofs and like to sell some of the excess electricity back to the grid, the €400 income disregard has been extended to the 31st of December 2028. Utility bills with price increases coming down the track is something that people obviously focus in on. The 9% rate on gas and electricity has been extended on to the 31st of December 2030. No cost of living assistance this time around, no. So no energy credits, which we would have become used to over the last couple of years. In terms of the non-tax measures, look, there was a number of announcements yesterday. I suppose key ones off this slide: €10 increase for those receiving social protection, CARES allowance, which I know was a big topic of conversation in the lead up to the budget. The income disregard has been increased to €1,000 for a single person and €2,000 for a couple. The back-to-school clothing allowance has been extended to 2- and 3-year-olds. That's probably to tie in with the fact that the ECI scheme now is seen as part of the schooling system. Permanent reduction in the €500 student contribution for college fees, and an increase in the fuel allowance by €5, and extending the eligibility to all households in receipt of the working family payment. In terms of businesses, again, this was probably the other big ticket item after much lobbying. The 9% VAT rate for the hospitality sector and hairdressers is coming back. It will apply from the 1st of July 2026. The reduced rate is confined to those specific activities rather than other activities of the business. So what that essentially means is for the food and catering sector, it will be for food and catering, accommodation and stuff like that won't fall underneath it. The R&D tax credit, some welcome changes there. The rate of the credit has increased from 30% to 35%. Another couple of tweaks. So if you've got an employee who spends at least 95% of their time in R&D activities, you don't need to worry about prorating their costs. You can just take a full 100% deduction for their costs. The R&D credit is usually paid in 3 tranches over 3 years, but the first payment was always front-loaded. The max you could get was $75,000. They've increased that threshold to $87,500. So essentially what that means is if your total tax credit is under $87,500, you get the full amount in year 1. You don't need to wait your 3 years. You'll be getting the full amount in year 1. They have announced that they are going to be looking further at changes to the R&D credit. They did name check 2 things that they will be looking at in particular, being the rules around outsourcing and also what the definitions will be for qualifying expenditure. The participation exemption for foreign dividends, foreign source dividends, was announced last year. What's that all about? It's a simplified mechanism for double tax relief. So previously, we would have taxed the income and then done all these fancy double tax relief calculations, more often than not to get back to a nil tax charge. Now they've just exempted the foreign source dividends from tax. That was announced in Budget 2025. What are the changes for 26? They've extended the geographic scope to jurisdictions that apply a non-refundable dividend withholding tax. Last year's announcement would have just included EU, EEA and countries we have a double tax agreement with. Now there can be additional countries coming in, like I said, if they apply a non-refundable dividend withholding tax. They've also reduced the period that the subsidiary must be resident in the qualifying jurisdiction. So per last year's announcement, it had to be 5 years. That's been reduced to 3, and there'll be further details around that in the finance bill. The other thing that the Minister announced yesterday was a look again at Ireland's interest regime, both the taxation of interest income and the deductibility of interest expenses. So the way to look at it is we have our own domestic rules on interest. They are quite complex. And from an international perspective, layered on top of that now are the likes of interest limitation, which has come in the last couple of years. All the rules need to be simplified. They're taking it out and looking at it again in terms of the taxation of interest income and the deductibility of the expense. What was announced really yesterday was a timeline. So phase 1 is going to take place over the next year. There's a feedback statement and further consultation in November, and there's other milestones that have been announced out over the next 12 months. What they hope to have is draft legislation on this ready for finance bill next year, so that the first of the changes will come through. The tax film credit, so there's an existing credit under section 481. They're talking about amending that for visual effects work. So this will be a new part, so the existing relief will stay there, but there'll be a new part to this relief. It'll be a new 40% credit for productions with a minimum of 1 million in spend on relevant visual effects work and a maximum of 10 million per production, and that is subject to state aid approval. Also in the digital games sector, there's a corporation tax credit which is available at a 32% rate on eligible spend up to 25 million per project. It's been extended for a further 6 years, and they've made another tweak to it. The nature of these digital games now is the first release comes out and then they add to the story over the years rather than making new releases of new games. So those post-release content, as they call it, will qualify for the credit as long as the original release qualified for the credit as well. Another good news story, the revised entrepreneur relief. So this is where if you meet certain criteria, the 33% of CGT rate of CGT is reduced down to 10% for entrepreneurs selling business assets. They've increased that lifetime threshold from 1 million to 1.5 million. That will take effect from 1 January 2026. So that is a positive change. I suppose we'd always look for that to go a little bit higher, and maybe they might look at that over the next few budgets, but we won't turn our nose up at 500,000 initially. The KEEP programme, that is a tax relief that allows businesses to give certain key employees options to buy shares in their business without triggering an income tax hit. So it's one of the main gripes that employees would have if they do get equity in a business, is that they're basically handed the shares, but they're handed a big income tax bill at the same time as well. So if you fall within KEEP, you can get yourself outside of that, and essentially any gain that's made then is subject to capital gains tax at 33%, rather than a portion of it coming in at marginal tax rates of over 50%. They've extended it out to the 31st of December 2028. I would imagine within that period they will look to try and amend it as well. Uptake has been quite low on it, and it does need to be tweaked. The Special Assignee Relief Programme, that's a relief for assignees coming from abroad to work in Dublin, or in Ireland, sorry, coming to work in Ireland. It's been extended to 31st of December 2030, which is the good news story. The bad news story is previously you only needed to have been earning a minimum of €100,000 to qualify for the relief. Now you have to be earning at least 125,000. How does the relief work? It takes 30% of the excess over 125,000 and disregards it for income tax. They're talking about simplifying the administrative requirements as well. So there's a notification period with this whereby you've got to get to revenue to say you want to claim the relief within 90 days, I think it is. They'll probably try to tidy that up as well and take down the barriers from an administration perspective in trying to claim that relief. Foreign earnings deduction has been extended also. It's a relief for employment income where an employee spends at least 30 qualifying days over a continuous 12-month period in a relevant state. So there's a list of countries where if you go to work for those days over the 12-month period that you'll qualify for the relief. They have included now Philippines and Turkey in that list. And the maximum relief has been increased to 50,000 in earnings, so a maximum €20,000 tax benefit. Again, they're going to look at the administration around this relief to see if they can tidy it up in the finance bill. VAT modernisation was announced yesterday. So domestic electronic invoice arrangements, there's going to be a phased introduction for business in business-to-business context, so for business-to-business supplies. Details will be published today. And basically this is following on from moves across Europe and beyond in terms of looking at VAT loss and VAT fraud. You'll see Making Tax Digital in the UK and other systems. There's a lot of tax authorities now that are moving to real-time reporting when it comes to VAT, similar to the PAYE modernisation that came in 2019. So here's our first steps towards it. We'll know more about what those steps looked like when they publish the guidelines on it today. In terms of pensions and savings, I've stood up here for the last couple of years and said, get ready for auto-enrolment. It's coming, and it never came. Get ready for auto-enrolment. It's coming, but it is coming this time around, 1st of January 2026. They have made tweaks to it. The tweaks are to bring the treatment of the savings scheme in line with other pensions, personal pensions. So with the legislation as it's currently drafted, if someone passed away, there would be an income tax hit before it gets transferred to the estate. That will be taken out of it now. It would have been subject to investment undertaking tax, whereas gains and pensions can grow tax-free. That's the way it'll be now as well with these changes. And also, they're tweaking it slightly to allow for an exemption from USC on employer contributions to the scheme. Not mentioned yesterday, but mentioned last year, was the standard fund threshold for pensions. So basically the maximum pension fund you can have will increase by 200 grand this year. And it's slated to increase by 200,000 a year out to 2030, and in 2030 it will increase in line with the average industrial wage. Tax and investments, there's an exit tax of 41% on UCITS, EFTs, life insurance products, and it makes it quite unattractive really with the tax rate that high. They've announced a reduction from 41 to 38. And I think the expectation would be that that would come down towards CGT rates 33% over the next few budgets. It doesn't apply to companies' personal portfolio investment undertakings or personal portfolio life assurance policies. There was a report on the fund sector published in 2024. The implementation plan for that report was published yesterday. There'll be a roadmap early next year for an approach to simplify and adopt a tax framework to encourage retail investment, and a public consultation on proposals to simplify the Irish real estate fund regime without limiting its effectiveness. There was also an announcement on stamp duty relief and share transfers. Basically, companies listed on regulated markets with a market cap of less than 1 billion, stamp duty on those transactions has been taken away, and there's an extension of the bank levy for another year. In terms of climate, the €5,000 VRT relief on electric vehicles has been extended by 1 year. And also for employer-provided vehicles, in the calculation of BIK on that, there's a new vehicle category, A1, and that's going to apply for zero-emission cars, so basically electric vehicles. And the range or rates of BIK in this new category will be 6 to 15%, depending on business mileage. The Accelerated Capital Allowances scheme has been extended for 5 years to the 31st of December 2030. So this is for energy efficient equipment or gas vehicles and their associated refuelling equipment. The carbon taxes increases, which we're used to every year now, an increase of €7.50 to €71 per tonne. What will the revenue be used for? Prevent fuel poverty, fund the warmer homes scheme, so for retrofitting, and encourage and support farmers in the green transition. The motor fuel changes kicked in at midnight last night. The home heating changes will be postponed out to 1 May 2026 to get us through the winter. For the smokers amongst us, the usual 50-cent increase on a packet of cigarettes. In terms of farming, The accelerated capital allowances regime for slurry storage facilities, which allows you to take a deduction for the expenses over 2 years, has been extended out to the 31st of December 2029. And there was also an announcement of a reduction in the flat rate addition from 5.1% to 4.5%. This is essentially a compensation payment for farmers who aren't registered for VAT. So if they go to the mart to sell their animals, they'd get up to recently an extra 5.1% tacked on to compensate them for their VAT purchases. That's been reduced down to 4.5%. The Minister for Agriculture published the report of the Commission of Generational Renewal and Farming. So basically, again, looking at succession in farming and how it can be assisted. There was a number of recommendations made, and some of them were picked up in this year's budget. So they extended the farm consolidation, stamp duty relief, the farmer structuring CGT relief, and the young trained farmer stamp duty relief out to 2029. And in terms of that farmer structuring CGT relief, it now has been extended to include woodlands and forestry. So what's next? Again, we've become used every year in these budget announcements, more announcements of reviews and committees being set up to look at different bits and pieces, and this year has been no different. Again, the interest deductibility rules, like I said, or the taxation of interest rules will be looked at. The R&D credit has been taken out and looked at again to see if it can be amended and improved. And also there's going to be a review of the taxation of the fund sector to make sure that it's as attractive as possible for retail investors to get involved. I suppose it's hard to stand up here and call a 9.4 billion budget packet cautious, but I think that was the tone that was being struck yesterday. Cautious, prudent, and I think the Minister, summed up his thoughts perfectly with this. We have to strike the right balance between increasing investment and moderating the growth in day-to-day spending. This is why our tax changes must be of a certain value and no more. Now is the time to steady ourselves on a path to the future. So that's it for me for the time being. I'll be back for the Q&A at the end, but now I'll hand over to David to go through the economic analysis. Thank you.
Thank you, Mike. A huge amount to get through, and I'm always amazed how quickly the tax experts manage to turn the analysis around. My job is a little easier. I just get to opine on the economy and what it might mean. So I think it's always interesting when you look at the coverage post the budget, and then even in the days following the budget, how the narrative develops around what a budget means to a different sector of society, of the economy. And you hear a lot of cliches around the budget. One of them is the devil is in the detail. I've heard that a lot in the analysis I've been listening to on the radio on the way down and on the TV last night. And there is a huge amount of detail to get through, and that's why narratives emerge over the following days. One cliche that I haven't heard this year, that has been a common one in the previous few budgets, is one for everyone in the audience. We often hear that around a budget time. We haven't heard it this year because the government has actually had to make some choices this year. And it hasn't had to make those difficult choices really for the past 4 to 5 years. We've had an embarrassment of riches from the corporation tax receipts. And now we're looking at a budget which in essence really is favouring supports for businesses and funding for infrastructure and other current spending initiatives like welfare and health over tax cuts for individuals. So the household sector feels like the part of the economy that's been left out in the cold in this budget. So before I get into the detail, and obviously, Mike has covered the tax stuff in huge detail, so I won't go over that again. I just want to take you through the backdrop, how the economy is doing, the context for this budget, and why the rhetoric from the ministers was quite cautious, if not actually what was in the budget. So the first thing to say is 3 themes to cover today. Global macro backdrop, uncertain. Irish economy showing resilience. And budget 2026, prudence, question mark. Not so sure. On to the global economy. Tariffs, I'm not going to repeat. We're living in President Trump's world at the minute. I'm not going to go into all the various machinations of the last few months, but we all know about tariffs. They're higher than they were a year ago, and they will have an impact. And the first impact really has been, it's dampened our collective mood. So here's consumer sentiment and business sentiment surveys over the last few years, and you can see the dip in our collective mood around COVID, around the war in Ukraine, and now around Trump 2.0. So firms and households tell surveyors that, do you know what, I'm a little bit worried about the future, I'm not so sure how things are going to play out. What does that mean? It usually means people might spend a little bit less, or businesses might invest a little bit less. We're not really seeing that yet. We're seeing, the only real firm impact we're seeing from US tariffs so far is a rush of exports. I'm not sure, is there anyone in the room here who's exporting abroad or selling to the US? But there's been this wave of companies trying to get as much product to the US as quickly as possible. So that sort of artificially inflated the global economy in the first half of this year, and probably for most of the rest of the year as well. So we're going to see a little bit of a crash. After the sugar rush, we probably see a little bit of a crash in 2026. And the question is, where does the economy find its level then after that? And that's the open question. That's the debate that's happening, because tariffs are an experiment. And here's just this year alone, you can see, based on all the wild proposals and statements from President Trump, we've been on a roller coaster. But it's an experiment where we've raised tariffs, or the US has raised tariffs to the highest level in 100 years, but it's in an economy that relies on globalization, on trade flows, on flows of capital and people. So if you think back to the economy in the US and our own 100 years ago, very different. A closed economy, we didn't do much trade outside of our borders. So this is an experiment that economic models and economists are really struggling with, because we just, the way we've been trained and the way our models have been built up is not predicated on increasing frictions in trade flow. It's been about globalization, and that's treated this economy and has been very good for this economy over the past 30, 40 years. So that's the big risk and the context in the background. And it is expected, best guess, this is from the IMF, that growth will slow. You can see the US coming back to the pack, the Eurozone and the UK there as well, over the next few years. So the best guess rate right now is that it will slow growth. And it makes sense, really, because the US is essentially putting a 15 to 20% tax on its own consumers. And when you put a very large tax on people, usually they spend less. So that's all in the background. US expected to slow. Unclear how it will impact other countries, and the Eurozone and the UK are near neighbours. But the expectation is it's not going to be good news, and it's really pick your poison in terms of how bad you think it might get. Having said all that, the Irish economy has been incredibly resilient. These are the various measures of the economy. You can see, based on GDP, our economy is nearly 600 billion in size. If you strip out some of the multinational activity and look at MDD, which is modified domestic demand, the green line on the bottom, we're about just under 300 billion size of economy. So you've got the domestic economy doing its thing here on this side, and then you've got the multinational economy, which is the tech sector and the pharmaceuticals on this side, and there are linkages and supply chains between the two. But what really drives GDP and exports is the multinationals, because we've got some very large ones here exporting a huge amount of very valuable products and services. And that generates that corporation tax bonanza we've seen in the last few years. Corporation taxes this year will be 32 billion euros. 10 years ago, that was 6 billion euros. So it's just phenomenal, the growth that we've seen in corporation taxes. And this enables the ministers to stand up on budget day and announce all of the various measures that he can. So phenomenal growth in the economy, and I would say resilience so far. And if you look at where the jobs have been created in the economy since COVID, because it's I suppose a good starting point to look at how the economy has changed. This is the cumulative growth in jobs, so the total jobs and where they've come from in the last 5 years. And you can see the collapse during COVID-19 in the first few quarters of that chart. So where have they come? They're largely actually in higher wage sectors. We're becoming more white collar and people are working on higher wages. 40% of the jobs have been in what you would call government-dominated sectors, healthcare and education, although there would be a good proportion of private sector providers there as well. Another quarter in the FDI sectors, so tech and industry, which includes pharma. And then another 17% in white-collar jobs. So people working in professional services, financial services, real estate, those types of jobs. So you can see there's a skew towards those higher wage sectors. Construction, we need more of those. Only 9% of the total jobs created since 2020. And then the rest account for the remainder. So an exceptional growth story in the Irish economy, nearly 425,000 extra people at work in the last 5 years, 2.8 million people working in the Irish economy. So a huge turnaround in the last 10 years. So we've shown resilience. As I said, we're seeing this surge in in exports right now. Oops, there we go. But we've also seen a surge in prices. So here's the inflation shock in the last few years. And all of these lines show the relative price levels. You can see the top one there, the pink line, is energy prices after the war in Ukraine. Peaked at nearly double the cost they were back in January 2021. They have since come back a little bit, but they are significantly higher than they were just 4 years ago. In total, average prices, the basket of goods and services that we buy is up nearly a quarter, 24%. And we can all see that in, when you do your weekly shop, you go down and buy your cup of coffee, and everything just feels more expensive. Over that same period, though, people's wages have increased fairly strongly, so the average wages are up 20%, but not quite as fast as inflation. So there's still a gap. So that means an erosion of people's spending power in the last few years. Now, if I put a chart of the UK and other countries alongside that, they're in a much worse position than we are. So our economy has been growing very strongly, and there has been good wage growth, but we still haven't caught up with all those price increases that we've seen in the last few years, and there's a little gap to go. And as I said, the tariffs will bite, but I think it's also important to remember that our exports are also in services, and they're not going to be impacted by tariffs. And in fact, we export a lot more services than we do goods. So that's our exports there built up in value terms from 2023. So pharma is a big story, but even bigger is the tech sector. So thankfully, there's no notion or signs that there's going to be any restrictions on that sector. But we also have very strong indigenous sectors like business services, financial services, our agri-food sector. The agri-food sector is facing tariffs, but in some cases, actually, the 15% tariff is going to be a little bit lower than they had faced before. So of all the outcomes that we could have faced, we're maybe on the more benign end of the scale based on some of the rhetoric we heard from President Trump. But I think we are seeing some little signs of weakness in the economy right now. Consumers are still spending, but in the business services, as I said, it looks like hiring trends are a little bit weaker. So businesses are just taking a pause on investments in hiring, it seems. And you can even see that we track data, and it's not in the slide deck here. We track the level of traffic on the main primary routes around the country. And you can see that while people travelling to work in their cars is still growing very strongly, the number of trucks on the road has just started to flatline a little bit. So these are the little kind of signs we look for in terms of maybe potentially turning points. And I think the jury's out for me and others whether this is just a little pause from corporate Ireland or it's something more enduring. My best guess right now is it's a pause, and we're starting to see things come back a little bit as that uncertainty starts to ebb away. We know what the tariffs are going to be, and we don't see anything too silly coming out of the White House in the next few months. So that's where we are. And actually our tariff is quite low compared to other countries. Germany has a very high tariff because they export lots of steel and cars, and President Trump doesn't like cars. Ourselves, we export lots of pharma, and that has a relatively lower tariff. So we've got off relatively unscathed so far. And the other thing to mention as well, which is really boosting our exports, is weight loss drugs. And it's a topic of conversation that I've noticed in the last few months. It's becoming more ubiquitous, more and more people using these types of drugs. And there's one facility down in Cork operated by Eli Lilly, an American pharmaceutical company, which has begun to export a component that feeds into their big blockbuster drug Mounjaro in the US and around the world. And that means that most of our exports in the first half of the year to the US were actually this one component of this single weight loss drug. 56% of all our pharma exports to the US in the first half of the year was from that facility in Cork, which is just amazing. So we've pivoted from vaccine production in the last few years to weight loss production. And there's another very large facility being opened in Limerick next year by that company. So spare a thought for economists trying to forecast GDP, because this just sends our numbers into the stratosphere, and it has done in the first half of the year. Does it mean anything for us in terms of the real economy? It will, because it's likely if they're generating more revenue in Ireland, selling these weight loss drugs, they'll be paying more money to the Exchequer. So what you've seen is the forecasts for corporation taxes have been increased in the next couple of years on the back of very strong growth in these sectors, and also increases in the corporation tax rate. So just one thing to call out, the Irish economy is And I think it's interesting around the business supports that have been introduced. Like, we do rely on this sector. It creates a huge amount of jobs. It has a supply chain. So we do need to protect that. We do need to look at our competitiveness and ensure that we remain attractive in a very competitive world to these companies. And there's a huge amount of competition globally for these sectors. So I think anything we can do to maintain that advantage is good, and that means, yes, investing in housing and investing in infrastructure and making the cost of living a little bit easier for people. So these are our forecasts. We expect growth will slow in the next couple of years, around 2%. Still pretty good in the European context, which is, European economy is growing at barely 0.5%. So a bit slower than we've become accustomed to in the last few years, but good growth. We are expecting a little bit of a drag on business investment, on hiring, while that uncertainty is there. It's inevitable, really, given the linkages we have between ourselves and the US. And there is obviously a big risk to the downside here if we do see something further from the US or retaliations from the Eurozone. So I would say, sum it up, cautious optimism for the next few years. Now, turning to the budget. Dear Prudence, we call it, question mark. It's a very large budget. Again, I'll not go over it too much, as Mike said, 9.4 billion. One thing I would call out, though, is every year, nearly as important as what's announced on the budget day is what happens during the year from budget to budget. This year, the government managed to spend nearly 4 billion more than it planned to last year. So that gets added into the base, and then you add on the extra 9.5 billion. And that's happened consistently over previous years. The big area of overspend has been in health, but this year we're seeing it across the board, education, other areas as well. So that gets baked into the base, and then the base goes higher when the minister announces his budget. Big increases to CapEx, to capital spending, into infrastructure, National Development Plan. We plan to spend 19 billion next year, up from 16 this year. I have my doubts whether we'll be able to spend all that money in a single year, but there is funding there earmarked for the big ticket projects like the Metro in Dublin, the Shannon water line to serve the Mid-East region, and other big capital expenditure projects, and obviously a big push on utilities and energy and water infrastructure. But that's a lot of funding to spend in a single year. So let's see if it gets spent. It is one of the biggest budget day packages ever, no matter what the minister says around prudence. Last year's package was about 10.5. This year's is 9.5 plus the 3.7 of overspend. I will say, though, the government has built up a very large piggy bank, so that's good, and I'll come back to that in a minute. So these charts just show the relative giveaways on the tax side over the last, back to 2006 actually. So you can see back in the Celtic Tiger era, we did a lot of tax cuts. We don't do that anymore. We tend to focus on the spending side. And here's the spending increases in a given year. Again, ignoring COVID, the spending giveaways in the last few years have been in line with what we would have done during the Celtic Tiger era. And how has that been enabled? As I said, corporation taxes are very strong. Our budget surplus was spiked last year by the monies from the Apple case, so you can see that line there. But this year, as I said, we're bringing in 32 billion in corporation taxes, 34 billion next year. Roughly half of it is estimated by the Department of Finance to be windfall or excess in nature. So, you would think possibly we should treat that as a once-off and we should be saving it. We're only saving about a third of it, so that makes me a little bit worried. But having said that, even though we're running an underlying deficit, which is that green line on the left-hand side, our debt has fallen significantly from the peaks of the post-Celtic Tiger era, and we have among the lowest debt levels in Europe. So I think that is a good story, and the government deserves credit on that score for reducing our debt levels. But what do we spend, right, in the economy, and how much does it cost? Well, roughly 40% of the economy is government spending or government taxes. And this is just comparing us to our European peers. You can see at the top in terms of revenue, tax revenues, you can see the Norwegians there. They take in a lot of oil revenue. And then at the bottom you see Ireland. So we're the lowest taxed of the OECD nations, of the rich nations, based on GDP. But GDP is sort of meaningless because it's inflated by the multinationals. If you use a better measure, which is GNI star, which just strips out some of the funny stuff with the multinationals, we're sort of that dark green line, middle of the pack in terms of our tax burden, in line with the UK, and a bit less than our European neighbours, including Germany. If you look at us on the spending side, again, as a percentage of GDP at the bottom, we spend very little as a proportion of our economy. But if you look at it based on our domestic indicators, we're kind of in the top half. And that's the bit that worries me, because if you compare us to other countries, we have a relatively younger population, we have a relatively growing workforce, and we should be spending less on things like health and social welfare. So my worry is over the next few years is that will continue to inch higher to where the UK and Germany is, with populations who are flatlining and declining, and much more of an old age population. So I think we just need to have what was missing from the debate yesterday is what's the long-term plan, you know? How do we deal with all these trends that are coming down the tracks, like climate, aging society, all of these things? How do we provide for it? And if you look at where we spend our money, roughly 2/3 is in 3 areas. So we look at the small, like we talk about, you know, the 9 or 10 billion, but the government spends 120 billion every year. So where does all that money go? 3 areas count for 2/3, social protection, health, and education. And social protection is a growing area, as is health, over the last few years. 27 billion this year in social protection, 26 billion in health, and they are set to increase over the coming years. So, you know, I think the rapid growth we've seen in spending, and here's all the forecasts, all the displayed lines going out to the right. These are what the forecasts were on budget day, and the black line is actually what happened. So we burst through all of our budgets in every single year, and the green dotted line is what we're planning to do in the next couple of years. Our spending is up 62% since 2019. Now, inflation, a growing population, you know, it would inevitably increase. But I think, you know, this is why you're hearing the central bank and others kind of warn, like, we really just need to be a little bit cautious here, particularly on the day-to-day and current spending side. We've seen a rapid increase in the last few years, and we just need to pull the brakes a little bit. And the government maybe has started to do that in this budget. Now, on the income tax side, I suppose people could feel hard done by. As I said, there were choices to be made, and there were no income tax cuts this year. I just thought it was interesting just now and finally just to compare us to other countries. Where do we sit on income tax? Are we paying a lot? Are we paying little compared to our peers? It depends where you are. So the line there in the middle is your average income earner in Ireland, the vertical line, 65 or 64,000 euros, and they pay an average tax rate of 28% all in. That includes cash transfers and other things as well, which make it a net number. If you're on a lower wage, you pay very little tax. You pay less than in the US and similar to what they pay in the UK. If you're on a higher wage, if you're at 200% of the average earnings, so you're earning over nearly 130,000, you're paying European rates of tax. That's the German tax rate at the top there. So I kind of turned, are we Boston or Berlin? We're increasingly the latter for personal taxes, and particularly if you're on average to higher income wages. And if you look at our personal taxes over a kind of broad sweep of time, what's the average that we've been paying? So these are 2 lines. So the green is as a single person with no children, and the pink line is a married couple with 2 children. And this is at your net tax rate, so it includes stuff like child benefit that reduces your tax. So you can see the single person is always paying more tax because when you have a kid or you get married, there are certain tax benefits and you get your child benefit and other bits and pieces. And this is a person or a couple on the average wage over time. So you can see significant tax cuts during the Celtic Tiger era, and then the very painful transition during the post-crash era. And we've really remained there, and we've actually gone higher. And this year, if I do that chart for this year, it'll go higher again. So our tax burden will be the highest it's been in over 25 years based on this budget. So very, you know, perhaps a bitter pill to swallow for people who are on average incomes, people who are going out to work and contributing to the economy. And then look at it a different way. So this is the average income, average earner again. Their gross income is on the top there. When the taxman takes his bit away, There's the pink line over the last 24 years. So you can see that jaw is growing between what your gross wages are and your net wages. And the green line then is accounting for inflation. So since 2007, gross wages are up, or the average is up 50%. After tax, it's up 34%. But if you account for inflation, it's only up 13%. So sorry to report that. So I think that gap, as I said, will grow and grow this year, grow and grow next year. So when you don't index the tax bands, you are in effect increasing taxes for people every year. Now, corporation taxes, I've already mentioned this, I won't go into it, but the top 3 companies pay about half of that, half of the 30 billion of corporation taxes, 15 billion. They are Apple, Microsoft, and Eli Lilly, who are making the weight loss drug. So we are very exposed, and we do need to be careful, because if one company has a wobble, that could have a very big impact on our tax take in a given year. Where we are spending a lot of money is on the National Development Plan and infrastructure. Huge amount of money being spent in the next 5 years, 130 billion. We will be among the highest spenders in Europe based on the size of our economy. And I think that's a good thing. We do need to spend it wisely. The government hasn't had a great track record of delivering big projects in the last few years. So I do worry, in an economy that is at full capacity, it's hard to get labour, prices are very high, that 19 billion I mentioned that will be spent next year, it'll be, number one, it'll be hard to spend it, and number two, we might not get a value for money. But we do need to try, and we need to actually deliver the infrastructure that a growing economy needs. So, final point is we have built up a piggy bank, and I am critical of the government, but they have built up a very large piggy bank. And if you look at where we were in 2007 before the crash, 2019 before the pandemic, and today, our debt levels are lower today than they were 5 years ago. The cost of that debt is much lower than it was in 2007 or 2019. And because we've brought in so much corporation taxes, we literally can't spend it all. It's impossible. So the financial buffers that we've built up are exceptional. So this year, at the end of this year, we'll have roughly 72 billion in cash or liquid assets just sitting with the NTMA, who are the Treasury Management Agency for the state. And that's compared to 30 billion 5 years ago and just 18 billion that we had heading into the crash in 2007. So if we do face a shock, if Trump does something silly, we have built up buffers to support the economy in the short term. And I suppose the message is, from economists and from myself and others, is that while the good times are here, let's keep building up those buffers, because it's not that long ago we were in significant trouble as a society, as a government, and use those buffers to support the economies during the downturns. So I'll leave it there. I think that's a positive message at the end. We have a huge amount of resources. We have a very dynamic economy. And I think some of the changes that are made in the budget can help that economy, but we also need a little dollop of prudence as well. So I'll stop there. Thank you very much.
Thank you for that, David. Good morning, everyone. My name is Tommy Hogan, and I'm the CEO of the Chamber of Commerce. And our President, Regina, is unfortunately unable to join us this morning, so I'm stepping in her stead. She's travelling for work. I know she'd love to be here, and I'm sure she's tuning in from somewhere. So good morning, Regina. The Chamber is delighted to partner once again with RBK and AIB in delivering this budget breakfast, and it's always great to get such a daunting piece of work as the budget distilled down into easily digested bite-sized pieces. So I'd like to thank our two speakers, David and Mike, this morning for doing a fantastic job. And I'd like to invite the two guys back onto the stage again. Now, if they could, please, I have a few questions I wouldn't mind putting to them. Thank you, guys. So since yesterday afternoon, the Chamber has been running a poll. Do you think Budget 2026 delivered for Irish business? And unbelievably, 100% of respondents so far are saying yes. So I don't know if there's a few entrepreneurs out there with 1.5 million on the hip, but I would just want to put it to you guys. Do you think Budget 2026 has delivered for Irish business? Mike, I'll come to you first.
I suppose for certain sectors, definitely, I suppose they'll be waking up. The hospitality sector, after much lobbying, have their 9% VAT rate, which, look, in all essence, I think the expectation is they won't pass that on, so it will be an additional 4% to their margins. Likewise, the R&D tax credit is positive, and for people in that space, it is something that they can look to exploit and get some much needed income into their pockets. So for certain sectors, yes, definitely, I think there's been some announcements there. In general, though, I suppose the way I would put it is it hasn't delivered much extra. It's been changes to existing reliefs and bits and pieces, but there's nothing new for the business community to maybe take a look at and explore if they'd be able to exploit it. So yeah, for certain sectors definitely, but I think that maybe in general people might be feeling a little bit left out.
Indeed. And you, David, what's your opinion?
I think so. It depends on your sector. Obviously, hospitality seems like a lot of incentives for the construction sector as well. Whether that has an impact, we'll see. I think Budget Day, though, can't deal with the sort of long-term fundamentals. It can to a certain extent. And one of the big things, if you give a VAT cut, it's a boost to turnover. But really, it's the cost issue that's the problem for many businesses. And one of the key ones, to my mind, is energy costs. We have among the highest energy costs, electricity costs in Europe. And I'd love to see a plan for how we reduce that. That could be a game changer. So, for example, in Germany, their big infrastructure plan, I didn't mention it in the presentation, but they're trying to boost their economy. And one of the things they're doing is providing energy subsidies for their manufacturing sector. Now, that's a short-term thing, but they realise that the European economy is at a disadvantage to others, and we have among the highest energy costs in Europe. Energy experts can talk to why that is. I'm not sure, for a variety of reasons. But I think we need to kind of grasp the nettle on those long-term challenges, and VAT cuts and stuff at the margin is welcome, but we need to really get a handle on the big long-term issues.
Okay, the SME sector is the backbone of the Irish economy, and sometimes it can be overlooked with the focus on the multinational corporation sector. And how do you think the SME sector fared in this budget?
For the SMEs, I suppose, again, it comes back to that sector-specific piece, but it's building on David's point on costs. As you look to the year ahead, we've an increase in PRSI costs, we've auto enrolment coming, we've the increase in the minimum wage. So the SME sector, I think, the economic outlook would state that the demand is going to be there again for their goods and services. So you would expect that the money coming in the door will be increasing as you go along, but I think the expenditure going out the door is very definitely going to increase as well. And it kind of was the elephant in the room yesterday was there was no plan around energy costs and labour costs, the increase in labour costs as well. The recommendation comes through every year for the minimum wage to come up, and it just doesn't hit that lower piece. It feeds up through the chain at every level. So wages continue to increase. So I think, as I said, the outlook would be for the SME sector that you have demand there for goods and services, but I think for the next budget they will be crying out for something to help them with the costs that just continue to rise.
Okay. And Mike, if I could just stay with you for a minute. If you were in the Minister's shoes yesterday, what are the key things you would have done differently?
I suppose one thing maybe, and I don't want to spoil the breakfast for anyone in the hospitality or hairdressing sector, but I suppose when you get into sector-specific stuff, you're always leaving someone out. And again, just going back to that point on labour costs, I know that a lot of the pre-budget submissions were talking about a PRSI rebate just to help with the labour costs. And I think, a rising tide lifts all boats. I think it would have helped everyone across the board with some of the costs, and for the hospitality sector would have put money back in their pockets, but everyone else would have got a bite of that 600 million annualised cost for the VAT rate cut. So I think for me that might have been a more equitable way of doing it, to try and get some help for businesses on those labour costs.
David, if you had the chance, what would you do?
How long do you have?
A few minutes.
Look, I've already mentioned around being prudent. I think the current expenditure that we're seeing, the increases we're seeing there are very rapid. And I think we do need, the Minister did mention yesterday about he was going to do a value for money assessment expenditures increase, are we getting value for money? So I'd love to see that analysis done in the very near future. I think people on middle incomes can feel very hard done by. When you see people who are on working age benefits, or you see other parts of the economy get something, I think it feels a little bit unfair for that part. And of course, there have to be choices made. And in an economy that is at full employment, and there's a multitude of work out there for people, I think making work pay a little bit better, I think would have been a good feature. But that's the Minister's choice, and there's very difficult choices to be made. Okay.
I'm very conscious of time, so I'll just ask one or two more. David, do you think we're as exposed today to corporation taxes as we were to taxes from the housing and construction boom in the mid-2000s?
They're as big as they were then. The key difference today is that we were all leveraged to that back in the mid-2000s. We had mortgages, there was debt, so the entire country and society was leveraged to that boom. It's different this time in that there's roughly, if you look at the multinational sector, they're half of our GDP, they're 80% of our exports, but they're only about 10% of our workforce. And so the big risk, to my mind, is obviously on the workforce, but is on the tax side. So there's a risk on the tax side, but it's not as significant as the housing and construction boom was back then.
Okay, and with significant tax revenues continue to be generated from corporation tax, the government is under pressure to spend funds. Do you think they struck the balance right between tax measures given the current economic climate?
I would have liked to have seen more restraint on the current expenditure, on various increases, payments. And so I think we should protect infrastructure. We should protect the most neediest in our society, but we do need some restraints. I would have liked to see more restraint on the current expenditure side while maintaining that boost to infrastructure, which will ultimately benefit us all.
Okay. And Mike, looking forward to the year ahead, are there any particular areas where you feel revenue will be focusing on with their interventions?
Well, I suppose not wanting to frighten people as they try to digest their breakfast, but yeah, revenue are, I suppose, getting more active now. What I would say is we probably got used to inactivity during COVID because a lot of the revenue officials have been put towards the COVID supports and administering those. I think we're just probably getting back to a level where we were previously. What I would say is that the interventions that they are undertaking are very focused. I suppose what we have to realise is that revenue have very good IT systems at their fingertips. They get a lot of information from returns from everyone across the board, be it personal or business or whatever the case may be. So they're building up a picture in the background. So the interventions that I see coming in, they're very targeted, they're very focused. And I suppose one area just to be mindful of, which has cropped up on one or two cases that I had in the last year, is the area around expenses to employees and remuneration for employees. And in particular, those expenses that you might be paying tax-free. We've had enhanced reporting requirements in relation to those expenses for a couple of years now, essentially real-time reporting on all of those. That has built up a much greater picture for revenue as to what's being paid out to employees tax-free, and it is a key focus to them now, for them now. And the thing is, a slight mishap here or there means that something that you were paying out tax-free could be deemed to be taxable. And when you're dealing with employment taxes at 50-odd%, it begins to get very expensive. So what I would say is that that's an area that they are focusing in on. But anyway, look, if you do get that letter through the door, the first thing I always say is, don't panic. It doesn't mean that there's something wrong. It just means they want to take a look a little bit deeper and always engage early as well. Get the letter, talk to your advisors, and more often than not, it can be put to bed relatively quickly.
Good advice. So again, conscious of time, we're pushing up to 9:10. So I want to thank you guys for your contribution this morning. It's very, very good, very enjoyable. So to wrap up, hearty thanks to Mike Scanlan, Tax Director at RBK, David McNamara, Chief Economist at AIB, and I want to thank a few other people in the room as well. Joe Cleary, Managing Partner of RBK, Deirdre McElroy, who put this event together. She's the Market and Development Senior Manager at RBK. The AIB team here in Athlone, Veronica Murray, who's the Retail Branch Manager, and Shirley Donoghue, who's the Head of Business Banking. I want to thank the hotel, Garrett and Sabine, the team here, fantastic job as always. I want to thank Coyle Events, Bugsy and Johnny over there in the corner, and TN Media, the guys going around taking the photographs this morning. And also finally, the Chamber office team who aren't here this morning, Sarah Jamieson and Kieran Wykes. So that's it for this year, everybody. I hope you've enjoyed the morning. That's Budget 2026, and we look forward to seeing you again next year. Thank you very much for coming.